Yeah, and sorry for not being able to be there in person. So again, thanks for having me to discuss this much needed work by Jim Androng in providing a synthesis for this rapidly growing literature in climate macroeconomics. And first of all, obviously, all the views, my views are not views of my employer. So let me just begin by latching on some of the very last things that Jim was saying. Looking at the history or the epistemology, struck by one of the things that he wrote in the draft that the history of macroeconomics is one of being surprised by events that end up having major consequences, and that reminds me a lot of the piece that Larry Christiano wrote just a few years ago called the Great Recession, a macroeconomic earthquake. There he wrote that the idea that financial markets could be ignored in macroeconomic died with the Great Recession. So now macroeconomists are actively thinking about the financial system, how it interacts with the broad economy, and how it should be regulated. And then just look me back to one of the last points that the Jim was saying that one way to think of the financial system as a shock amplifier. And the reason is because a climate-related shock by itself might not impose such big importance, but if you think of the amplification, in this case amplification to the financial system, the shock can have much bigger consequences. So the task, one of the main tasks in my view, is that also I agree with them, is to understand what are the potential amplifiers that could turn a modest shock, like a hurricane shock, or into a threat to the financial system or the macroeconomy. So my focus on this talk is just simply to complement what Jim was talking about, but the focus here will be on the financial side. So I want in this brief presentation, I will try to document three empirical pieces, three pieces of evidence on the effects of climate risk on three pillars of financial amplifiers. So housing prices. Next is mortgages and mortgage-backed security, and the last is government-sponsored enterprises. All of these play a big role in the Great Recession. So, but before I do that, let me step back for a second to see, to take a big view, a paranomic view, my view of the current research landscape. I think there are three branches, broadly speaking, all growing very rapidly, but largely independently. So I would say first, the one thing of the climate micro. So that the literature provides very careful estimates of the climate damage elasticities. For example, what are the effects of weather shocks on crops, on productivity, on mortality? So they provide quite useful estimates of the elasticity of adaptation. So how will the weather shocks affect the willingness to migrate or the willingness to take up insurance? I think this estimate is quite helpful for us to build models of adaptation. And I think there's a lot of surveys out there, but I think a very good place to look at this. The survey of this literature is coming from the National Climate Assessment chapter. Now, the chapter in economics that was released literally just 2 weeks ago. So I was a part of this team of about 10 economists trying to, in the past 2 years, to try to provide a synthesis of this literature on climate economics. And we provide various different summaries, and one of them is actually one table where we put a big table that provides a brief summary of what different kind of estimates the literature has found. So that could be a very useful point of reference. And the second literature is what Jim focused a lot on is the climate macro. So there the main focus is to think about the feedback between climate damages and macro variables and policies like taxes, right? So like Jim was saying, the focus has been, for example, social cost of carbon. Empirically, they try to estimate the effects of temperature shock, let's say, or disasters on economic growth. Or there's also some work trying to look at energy transition policies and the nascent literature on adaptation. So Jim and Androng will provide one much needed updated synthesis of the latter literature. And finally, I think there's this important literature on climate finance. I know that we have this on the conference. I know Johannes will talk more about this as well. But there, I think the literature is quite exciting because it's helping us to understand how financial markets are anticipating future climate risk. Right? Keep in mind that most of the climate damage are in the future. So anticipation can play a very important role, right? So the literature has done, I think, it's quite interesting jobs in looking at how, for example, the effects of anticipated future sea level rise related risks, like flooding risks or storm surges, how this anticipated risk would affect housing prices today, or how anticipated transition risk will affect stock price and investment decisions today. So there's some excellent surveys here. So Harrison Hong et al. And also Johannes and his co-authors present some excellent reviews of this literature. So my view is that these three literature has been pretty much rather largely developing independent of each other. And if you think of them as like vector spaces, what we really need is a direct sum of all of these different literatures together. And I'm going to focus on the last two, the bringing together of the macro and finance. So to do this, so let me point to some selected recent empirical findings on what are the potential risk amplifiers in the financial system. So let's look at the very, very key pillar of a financial system and financial system amplifier and stability, that is housing prices, right? So there's an active debate in this literature. But I think my takeaway from this is that the evidence has been pointing that housing markets have started to anticipate the long-run effects of climate change risks. So, for example, the risk of future sea level rise is being anticipated in the housing market, in coastal housing markets. So the estimates of this effect it's been documented to be negative. However, the estimates vary a lot across the different papers, so the magnitudes vary. And one thing is, I think it's consistent in this set of literature is that the magnitude is being increasing over time. So the degree of anticipation of future, let's say, sea level rise risk being stronger and stronger over time, consistent with the idea that attention about climate change becoming more salient these days compared to say 10, 20 years ago. Furthermore, the magnitudes of this pricing of future risk depend a lot on the belief factors. It's very, very important, right? So the estimates generally point, for example, that in areas where people are more pessimistic about climate change, people are more, more worried about future climate change, the magnitudes of the effects will be stronger. In areas where people are less concerned, are more optimistic about future climate change. For example, in areas that people do not believe that climate change is happening at all, I would think that that's very optimistic. Then the magnitude is a lot of times insignificant. There's no effects of future climate risk on housing prices today. No. So different papers have been documenting this. Overall, when you take, there's other papers also showing that, arguing that current housing prices are underestimating climate risk, and they define various benchmarks for what efficient pricing is. And then under different definitions, the papers tend to find that current housing prices are arguably underpricing the future climate-related risk, and therefore that leads to potential for repricing events, right? So where some kind of events, news that make people update the belief, for example, can trigger housing price decline. For example, and recently it's documented that so after Hurricane Sandy, the premium of living in a coastal property declined, even in areas that are unaffected by the hurricane itself. So reflecting that example of a repricing event. So that's the first point on housing prices. And then now talking about the second and third points of mortgage-backed securities, mortgages, and the government-sponsored enterprises. I think that that's an interesting several papers in the literature documenting there seem to be evidence of strategic shifting of climate risk in the financial system. So we think of this as like adaptation to climate change through shifting of risk. So evidence suggesting that home buyers can shift climate-related risk to banks via risky mortgages that they fall upon when disaster hits, and that destroys the value of the collateral assets. Right? And then the banks in turn can shift this climate-related risk to the government-sponsored enterprises through the process of securitization. So let me elaborate a bit more on the first point. So in a working paper that I have with Laura Beckerson and Russell Wang, we were surprised to find the following empirical findings in the data. So we use coastal real estate transaction data in the US. We find that all else equal, a property that is more exposed to future sea level rise risk is more likely to be leveraged. So more exposed houses are more likely to be bought with a mortgage. That's the first finding. And then condition having a mortgage, exposed houses are more likely to have longer maturity mortgage, more likely to have 30 years than 15 years. And maturity is important, right? Because climate change, like I mentioned, is a long-run risk. So a longer maturity, mortgage contract are more likely to expose with more risk than a shorter-term maturity, right? Um, and this pattern is particularly strong when the buyer is more likely to be pessimistic about climate change, and that's based either belief survey data or based on our own imputation of beliefs based on housing price and transactions. And this, for us, a little bit surprising at first, but then if you think about that, we wrote a model. It's very consistent with the idea if home buyers can potentially shift the climate risk to the lenders with the option to default on a mortgage in the long run when the disaster actually eventually hit. And so, but then you might think, okay, so why are the banks, the lenders, maybe optimistic to willing to give out these loans to these risky loans? And then actually, there's some recent work documenting that the climate securitization mechanism. So banks tend to securitize and offload mortgages, risky mortgages, to properties, loans to properties that are at risk of future climate risk by securitizing them, right? So because the idea here is that the government-sponsored enterprises, the rules reflect historical flood risk, but not forward-looking future flood risk due to face sea level rise. So as a consequence, the government-sponsored enterprises are pretty much optimistic in a sense. They base they not fully take into account climate risk, and as a consequence, climate risks are being shifted to the government-sponsored enterprises. From several works by Amin Ozad and Matt Kahn's been documenting this climate securitization hypothesis. So, and this kind of works, I think, lead to some potential important policy implications. So first of all, kind of interesting is that we usually think of adaptation. We should protect our economy, our homes, our firms from climate-related risk. However, adaptation in the financial market could have interesting implications. So, in particular, strategic adaptation in financial markets might have adverse effect on financial stability because it might lead to concentration of climate risk in a few systemically important institutions like the government-sponsored enterprises. Also have implication because the concentration of risk, the shifting of climate risk, may make prices of agency MBS, so MBS by the government-sponsored enterprises, sensitive to climate-related risk, right? And let's remind ourselves that the agency MBS are commonly used as collateral in the repo market, so that some movements in MBS pricing might have implications for financial stability. However, to be clear here, right? These are potential implications. Much more work is needed to estimate the degree of concentration in the climate risk in the GSEs, and much more work is needed to estimate the MBS sensitivity to climate-related news shocks. These are, I think, the wide open questions for future researcher. And then another implications, and that's relevant for us, the audience in here today in the central banking world, because we tend to think of things in the medium term, like 5-10 years, not 50 years down the road, right? So because the literature has pointed out the fact that even though climate risks are long run, but climate-related news or belief or salient shocks are not long run. They're well within the business cycle's frequency, right? And therefore they're relevant for policymakers and central bankers. Again, back to example that $1 billion disaster, like most of them hurricanes, which happening pretty much every year now, very high frequency now. This $1 billion hurricane can lead to repricing in the coastal housing prices that I mentioned to you earlier, and also and this event can increase the climate securitization of conforming loans that are exposed to higher future sea level rise, climate risk. And also lead to reallocation of loan portfolios in banks. I have another working paper. We found that after the big hurricane, large banks actually reallocating the portfolios of home equity loans to adjust to adapt to future flood risk. So this disaster can provide news that trigger changes in the financial markets. And then one of the last slides I'm going to show you here is that it has implication for the modeling. So the current climate macro models, I think they're not yet useful to guide policy discussions on climate change and financial stability, and largely because they don't have the financial accelerator, right? So, so I think we can do this by simply. I think we can really augment an existing, say, DICE model with a financial accelerator. I think through a Bernanke-Gilchrist or Kiyotaki and Moore kind of framework. And also that's one side to the amplifier. But also we need to incorporate shocks to beliefs about the long-run risk, right? So, for example, I have in mind is that a prototype of a climate macro finance model could be something like this: a model where the shocks to climate belief coming through news, so a new IPCC report, new national climate assessment reports, news disasters, or that lead to belief updating and learning. So shocks to climate beliefs that affect how prices collateralize assets, in particular housing, and then through the financial friction and acceleration, that's one known in the literature, that can lead to discernible impacts on macro variables that we all care about. Right? So I think it's a very exciting opportunity for us to build this kind of climate macro finance models to think about these important policy questions. So let me just conclude here. I think it's really exciting time to be a climate economist, and I will really hope to see the literature converging, the three different silos of this, the literature converge together to get a grand unifying theory that combines both the climate macro that provides good empirical, reliable empirical estimates of elasticities with the climate finance literature that provides, good insight into how asset prices and risk management are anticipating future long-run climate risk. And with the climate macro literature, I've been thinking a lot about social cost of carbon, tax and policies, and I think a new nascent little field of think of macroprudential climate policies. So let me just end here. Thank you.
So now we have some minutes for questions from the audience. If you are in the first rows with a microphone, a set microphone, please, you need to turn it on and also turn it off for getting next questions. And also we'll have a microphone for the rest of the audience if you want to raise any questions for James. Elias.
Thank you, Professor, for that great overview. And I thought the discussion was also a very good complement to some of the ideas that you discussed. I wanted to make a comment, really, perhaps a challenge on some of the issues that you mentioned. I thought it was a very relevant point you made about the fact that all the models out there find really small, direct macroeconomic effects of climate change. So, for example, I've looked into this issue using the NGFS models, which tend to find large effects. And those effects are 10% of GDP towards the end of the century. But as you will say, you take the central shared socioeconomic pathway of the IPCC, and GDP is expected to actually increase fivefold. So, 10% of fivefold, this doesn't look so bad. So it's a small effect. And I thought your point of, maybe things that have a direct small effect can be amplified. And I thought that the discussant also touched upon this with a particular view on the financial system. But I want to challenge the view on the direct effects. I mean, those effects of the 10% loss of GDP are simulated on scenarios where the temperature increases by 4 or 5 degrees. I mean, these are catastrophic scenarios. And to think that we are going to have 4 times the current GDP in a world that has 5 degrees Celsius is just telling us that our models are wrong by orders of magnitude. I'm not sure where they are wrong. I mean, that's kind of the work that we're trying to do at the NGFS. But I think that there is a consensus that at least the physical impact models are getting it wrong, but wrong in orders of magnitude. So let me just offer an idea, and I think maybe Justin Johnson will speak about this when he touches upon broader aspects of nature that are involved in the environmental crisis, because this is not a climate crisis, it's really an environmental crisis that touches upon many dimensions that I think are well captured by the research on planetary boundaries. So climate change is one of the dimensions. You have many dimensions, and the key aspect is that they interact and mutually amplify each other, right? And we just finished a review on macro modeling on these topics, and I would say roughly 90-95% of the models that you review basically have one environmental stressor, typically temperature increase. That's it. And there's a discussion on what the elasticity is of increasing 1 degree on the damage function and so on. But in reality, there are multiple stressors. And when one gets worse, it worsens all the others, and pretty soon you get an amplification that makes this problem highly nonlinear. I mean, each dimension is nonlinear in itself, but the interaction between them further amplifies this nonlinearity. And we are not, at least in my reading of the literature, we are not even close at being, using models that capture this well. But I think as we make advances on this topic, we will soon find that the direct effects are pretty large. But that's just a hypothesis at this point. So that would be my comment. Thank you.
Thank you, Elias. Any other questions? Yes.
So I got interested in the difference you showed between the carbon tax and the cap and trade system. And I wondered, I have an intuition, but I wondered if there is a narrative behind this. Intuitively, I would say that a cap and trade system is going to generate more uncertainty for the firms who have to make investment decisions. And on top of that, the cap and trade system implies that during economic booms, supposedly with a cap, the price is going to also boom, and it occurs at the moment where maybe the firms are more willing to generate investments. And these probably also parallel, the vision of environmental quality regulations in general, where when you delegate more actions to the agents who are burdened by the policy, generally there is a larger cost. But maybe there is another narrative, and that's why I'm asking. Thank you.
Thank you. Yes.
Thank you very much. Very interesting presentation and discussion. I have 2 questions. First, on you mentioned the results from your paper on carbon taxes and how they are different from the results from the other paper from Diego's on the cap and trade and so on. You said it's not econometrics. I trust you if you say so. I wonder what in your view, if you can elaborate, what might be driving the difference in the results, because they were surprising. No, as you said, we tend to think of carbon pricing as this thing with several instruments, and conceptually at least they seem to be quite substitutable. But then you show results like the ones you show, and you're surprised. And then the second question I have is on your blank slide on the economics of adaptation. So I wonder, in your view, what are the elements that the academic community should be focusing on to fill that blank page on that dimension? What are the areas in which you would like to see more research on the macroeconomics of adaptation? Thank you very much.
Thank you. So, Jim, a lot of things to address now.
Okay, good, great. These are really great questions. I think this question about what, are these, do we really think this 10% on a factor of 4 or a factor of 5 is a plausible thing? And you're right that some of those are for like a 4-degree world. So no, that just doesn't sound right. That doesn't sound right. But as you start to parse that, you really just get into this science fiction stuff. What if we move a bunch of our production underground, or, change the way, and we could still have GDP living underground, and there are parts of the world that, have sort of, you outside at night and not during the day. But I think that just goes back to the problem that GDP is just an incredibly poor measure of overall welfare. And if you think about planetary boundaries, part of that is effects on human welfare, but part of it is actually just taking what are the effects on ecosystems and treating that as having direct value. So I think that goes back to the second part of this conference. So I don't actually disagree at a really high level with you. I would actually just interpret that as, well, I would interpret that as a problem with the GDP, but you might interpret it as a problem with the models, but this is all. But I do actually go back to my point, which is that why don't we just declare victory? $190 is big enough for us to get on with the job, and we should just get on the job of the decarbonization enterprise, and then thinking about the implications for monetary policy. This question on carbon taxes and cap and trade. Yeah, so there's two big things. One, the fluctuations in the cap and trade system are these unpredictable ones, and they're fairly high frequency. And so that has two features. The unpredictable part means that you don't have the incentive for investment in that, so you're going to have a discouraged amount of investment in transition to green power. Second is, if it's high frequency, then you're just stuck with short-term, there's another way to say it, but you're stuck with short-term elasticities. And we know that demand for electricity and demand for steel and so forth, short-term elasticity is really, really small because you've just got those things locked in. And where you have time to adjust is when you say, gosh, this is going to be with us for a long time, and then we can be playing off of the long-term elasticities and smoother transitions. So I actually think this is really speaking in an important way to what we often think of as two different flavors of carbon pricing is actually having very, very different implications because of the fluctuations and pricing fluctuations. Now that's speculation, but it's consistent with these results, and it'd be great to get more evidence on that. On the economics of adaptation, we're going to hear a little bit about this, I think, from Tony, talking about international aspects and regional effects. And I know there's I'll plug a paper that is joint by my co-author Adrian Bilal and Esteban Rossi Hansberg, where they look at adaptation. They do a pretty complicated model. It's quite granular within the United States, and so they look at the effect of sea level rise on migration from impacted coastal communities to other communities, and then what are different policies that you might have. Should you go back and you rebuild in the coast? What if there are frictions on migration? So starting to ask the questions of what are the right sets of policies? Should we provide incentives for people to move? What if people get stuck and capital moves? So providing a modeling framework that allows us to ask counterfactual questions about adaptation policy at a granular level, and then be able to talk about welfare. That seems to me that seems to be like a great research agenda. I'm not saying this paper isn't the end of that agenda, and the work of Tony and Per is important in this area too, but that's an example of one important adaptation mechanism, which is just moving and abandoning certain types of areas. But there's lots of other aspects of adaptation policy. I think Matt Kahn has really interesting work along different aspects of adaptation policy. That's more at a micro than thinking about the macro consequences, but thinking about some of that in GEQ is probably an interesting set of things to do too.
Thanks, James. And I think with this we wrap up a very good start of our conference. Please give a round of applause to James and our discussants.